Thank you, Ashley. Thanks for coming, to all of you. A lot of material and precious time, and I'm going to try to underutilize my time so you can ask more questions. I spent most of the last 8 years as the chief U.S. economist of UniCredit Group, starting with Hupo Vereinsbank, which owned Bank Austria, Creditanstalt, and then 2 or 3 years ago there was a merger with Italy's biggest bank, UniCredit. So this is a bank that's one of the biggest, one of the top 5 in Europe, 170,000 employees, and big activities, particularly in Europe, Eastern Europe, some in Asia, and some in the U.S. So I saw this primarily as a practitioner and as an advisor to our management and to our clients. And I guarantee you that it was like watching one of these traffic accidents in the Smoky Mountains, where 40 or 50 cars pile up, and the number 50 had no idea that there were 49 wrecks in front of them because of the fog. And there's certainly been a lot of fog. We've been following securitization basically its whole life. Started in about 1980, started very tenderly, gingerly, with what we call Ginnie Mae pass-throughs. Went through many, that's Government National Mortgage Association. Pass-through meaning that you bundle 1,000 ordinary mortgages, take the cash flows, divide it up against the people who invest in those pools. So take a lot of loans, put it into pools, divide up the cash flows, and this allowed all kinds of institutional investors primarily to diversify their holdings of their exposures to the mortgage market geographically. In the old days, you might be able to invest in a local regional bank or even a big New York bank, but you wouldn't get the ability to diversify geographically. Securitization had that huge benefit. And because the government was involved, in the case of Ginnie Mae, 100%, later on Fannie Mae and Freddie Mac, less than 100%, but still involved, that provided a lot of comfort to a lot of investors. And the U.S. mortgage market blossomed, and it was a big support to housing. One of the reasons why the U.S. has so little saving and so much spending is we put a lot of money into housing, and other countries don't. But the securitization principle is not new. It's well tested. It's a mature institution, but it got perverted in a very short period of time between about the years 2002 and 2006. Such perversion led to the greatest financial calamity in our history. And it didn't just take down the U.S. financial system, which has now required at least $2 trillion worth of support from the Fed and another trillion and a half from the Treasury, and many other countries are having to do the same thing. These are unimaginable amounts in the year 2002, and it all happened that quickly. So I like to read mystery books. I like the older ones the better, original Agatha Christie. In fact, I read them such a long time ago, I can read them all over again, and I can't remember anything about it. So always start at the beginning, and as she wrote these books, and she's sold even more than the lady who did Harry Potter, why is it that women are great entrepreneurs in the writing of very, very well-sold books? They had the list of characters, and I found myself going back and forth to this cast of characters list all the way through the book, because all the names sounded alike, and basically all the books sounded alike. So we need that here too. Who were the cast of characters that created this catastrophe in the financial system? And there are about 7. One are reckless borrowers. Americans love to buy houses. They love it even more if the credit is cheap and widely available, and they believe that housing prices always go up. And that led them to be particularly reckless when money was thrown at them by all kinds of eager lenders, beginning when the Fed was really easing monetary policy after the collapse of the high-tech bubble. And lending standards, time-tested lending standards, for centuries went out the window. And we saw, for an example, some numbers are necessary. In the year 2000, how many mortgages had zero down payments? Well, the answer is almost zero. By 2006, almost half of all mortgages in this country had zero down payments, either directly or indirectly through back-to-back home equity loans made at the time that the original mortgage was. Now, this is a tremendous collapse in lending standards from the normal 15 to 20% down payment, which had been watered down to maybe 10%. Borrowers took it on, and the risk, because they blithely thought that housing prices would go up forever, and they certainly were going up because there was a greater demand for housing because credit was so cheap and widely available on such easy terms. So this is where macroeconomics comes in handy, to see the what you might call the cumulative effect. For any individual borrower, seems like a great deal. When you add them all up together, you put upward pressure on prices, which makes the boom bigger, and that sets the stage for the bust. Then we have what I would call, I would say unscrupulous is a fair word, originators. Who were the originators of these kinds of mortgages? Some were total unknowns, even to the Fed. They were not banks. They were not even traditional finance companies. They were people like New Century Financial, headquartered in California. When it failed in February of 2007, I got phone calls from my friends in the Fed asking, who is New Century Financial? And pretty soon they found out. It was one of the top 5 originators of these kinds of mortgages, and they were totally invisible. But some were not invisible. Citigroup has a mortgage subsidiary called Citicorp Mortgage, and it was one of the top 5 originators. HSBC, global bank, huge powerhouse, had bought Household International, a well-known finance company. They were in that. And GMAC, 1/3 of GMAC's business was residential mortgages. A lot of those were subprime. A lot of them ended up bust. And GMAC right now is a ward of state, receiving TARP funds just like Citi. Then we have what I call cynical packagers. Remember how securitization worked. You bundle up a lot of loans, you then issue some bonds, bond-like instruments against those packages, and then the investors deserve the cash flows based on those little pieces of original mortgages. Well, this was a business that only made a lot of sense when the government was behind it, whether from Ginnie Mae, then to Fannie, then to Freddie. But when no one was behind it, except the originators themselves, the level of risk was greater, but the packagers never held very many of these securities themselves, not at the beginning at least. They were able to sell this into the market because of another dramatis personae, the conflicted rating agencies. Put high credit ratings on them, and buyers all over the world were buying them, really without doing their own due diligence. So on the list of culprits in this mystery are what I call lazy buy-side investors. They can be insurance companies, they can be other banks, they can be pension funds, they can be wealthy individuals or institutions operating on their behalf. And I guess finally, there are 2 more very important culprits in this. One I call reluctant regulators. There was never any one person in charge. There was no one institution in charge of watching this development of this overheated, sort of the mortgage market on steroids. Nobody had the responsibility of overseeing all of it. The Fed had a piece of it, but it wasn't to them the most important thing they did. Some of it was the responsibility of people like the FDIC, very fine institution, but not much. State-level regulators had some of the responsibility, and when nobody's in charge, specifically, nobody's in charge. And finally, and last but not least, and often, and probably the least talked about by the media, are the boards of directors of all these companies. What were they doing? What questions were they asking? How much of the risks being taken by their employees, the CEO, the CFO, and so on, had they identified and monitored? Did they understand what was being done? Well, the answer is obvious. If you go down the list of the boards of directors of the major institutions that have received TARP money from our Treasury, that's the big, the handout that began under Paulson about a year ago, you will find that hardly any of them had any background whatsoever in these markets. I made a point to one audience that the 26-year-old being hired out of Wharton to Morgan Stanley would know far more than any member of the board of directors of Morgan Stanley. And I'm not picking on Morgan Stanley. They're a fine institution in many respects, and they are certainly money good right now. But the boards of directors of these firms did not know, did not understand, did not ask, and in the end did not do their job as corporate governors. So where do we go from here? Will there be another? Will there be another crisis? And Ashley's already answered yes. I don't like that answer. I think I would like to avoid one. I think that many things can be done to avoid it. And here's what I think should be done, some of which is in the Treasury's proposals, but I'm disappointed that they haven't taken advantage of the anger of the voters to do something about it. We're already in October, and they're still dithering around with the Congress, and I don't understand why. I mean, what a golden opportunity to move this forward right away. And the building blocks were there because Paul Volcker and the group of 30 had a report. It came out in January, and most of what's in the Obama plan was in the Volcker report. And why did it take so long to get to Congress? And you know why. Because when you have tougher regulation, somebody is going to be constrained. That constraint will mean less profit opportunity, less ability to do what they want to do. And what do they want to do that's so important that it should be left as a possibility to create another crisis? Well, the unhappy answer is they want to gamble. They want to take risks that are potentially excessive, and the only way to rein those in is through better corporate governance or limits on the benefits from taking those risks, which is what is being debated at the G20 meeting this weekend in Pittsburgh, namely compensation limits. So that's got to be done. I would add that 3 or 4 other things need to be done. One, we need an FDA. The Food Drug Administration acts in the public interest. They prevent certain drugs that are really dangerous, have very bad side effects from being sold. Well, some of these financial products are very dangerous to our economic and financial health, and we need a body to assess them. And by the way, it's actually easier than you think. If anybody would have asked one question, can you unbundle these complex securities? Show me how you will do it. The thing wouldn't have happened because everybody would have realized immediately they couldn't be unbundled. I've talked to the top lawyers and the banking lawyers in the country who said that if you read the prospectuses, read the documents, you would realize they could not legally be unbundled. And we got to stop that. We've got to make them, if you package a whole bunch of loans, you've got to have a mechanism for unpackaging them. If you have that, you won't have this crisis again. You might have other kinds of crises, but not this one. Secondly, we need more competition among the rating agencies. I said they were conflicted. How were they conflicted? They were earning fees for putting AAA ratings on these pieces of paper. And many of the institutions only bought them because of these AAA ratings. Now, if we had more rating agencies that people could turn to, if there wasn't a kind of a monopoly position, there was more competition in ratings, somebody would have said, wait a minute, these things can't possibly be that good. And that would have helped a lot, because then people would have said, well, maybe I better look into it myself. It's called due diligence, and the big buy-side institutions should have done it. I'm convening a panel at the Council on Foreign Relations in New York of buy-side institutions from around the world who said no. We never bought any of these things. I want to do a little bit of this kind of artificial intelligence. How did you make that decision? That was a great decision. What lessons do we learn that other institutions should have brought to bear when they made these judgments? Maybe they have something to learn from you. listening to the people who got it right by staying away can be very healthy, and I think the regulators they'll send people. I'm pretty sure of it. I'll arm twist them to come. More capital is on the G20 list, so I don't have to say anything about that. Why do banks need capital? Because it puts the shareholders at risk, and that'll encourage them to hire better boards of directors. That's self-evident. They have to have some money in the game. The CEOs and the CFOs have some, but not enough. And finally, we need an explicit coordination of national approaches to regulation. It is inconceivable that we can harmonize all banking and financial regulation. Every country has a whole library of rules and regulations. To actually start from scratch is literally impossible, because you can never stop the game in the middle, and so you can never really have a full-fledged changeover. It's too complicated. Just like it would be too complicated to harmonize the criminal law of 4 or 5 countries. So we've got to just have more coordination. It's doable. It's on the list. When we got the right institution already exists. You don't have to create it. It's called the Financial Stability Board. It used to be the Financial Stability Forum at the BIS in Basel. We'll use them. They'll be great. Most of these things are by government. They're improvements in government oversight of the process. But I didn't say we need regulatory reform. I said we need governance reform. So the final point is we need a wholesale reform of the way financial institutions are governed. And we had some of this already. We had a crisis, a big one. It was called the thrift crisis of the 1980s and early 90s. We passed a law called Fiducia. And one of the things that it did was put very explicit responsibilities on members of boards of directors of depository institutions. What happened to that? Well, it still exists. It could be broadened, because many of these institutions that got in trouble, AIG, for example, or Lehman, they were not depository institutions, so it should have extended to that. But if you don't have the boards of directors of private institutions taking the responsibility, no amount of government oversight can substitute for that, because they are the people who are the guardians of the shareholders' money and of the shareholders' futures. So that's all I want to say. Read the chapter, but stay with the issue, because this is great, because it's not over. I thought it actually would be over. I'm sure Geithner will have this all wrapped up by the time you have your meeting in September. Didn't happen. Thank you, Tim.